So welcome everyone to yet another amazing session on CF and financial reporting, and I hope our audio is absolutely amazing, right? So in this session we are here to revise the content of INDES 103 business combination, and this lecture is going to be in 100% English. So if you are watching this on YouTube, please hit the like button. If you have already hit the like button, then hit the subscribe button, okay? And if you have hit the both, then in case if you have not have enrolled for the session, you can enroll on bbhl.com. If you have enrolled also, then you can recommend your friends to enroll it. Oh, wow sir, chalo. So on that note, let's start the revision of INDES 103 business combination. Do remember three things. First, this is going to be in 100% English. Second, in this revision we will cover the concepts as well as the questions. Third, let's start. Okay, so without wasting the time, let's start the revision in 3, 2, 1 and go. First of all, the point was definition of business combination. When we will call any transaction as a business combination, so first of all there are two parties involved here. One is the acquirer, that is a purchasing company. Second is the acquiree, that is the selling company. Here the purchasing company goes on to become the parent company also, and the selling company goes on to become the subsidiary company also. So when it will be a business combination, so in business combination, one acquirer obtains control over another company's business. So if any company is obtaining control over another company's business, that is known as business combination. So in case you remember, we took one example as well, right? For example, let's say that AK Limited is obtaining control over Mukku Limited. So who is AK Limited? AK Limited is the acquirer and Mukku is the acquiree. Okay. So now how can you obtain control? Control can be obtained by two ways. First, you can either acquire more than 50% equity stake. Okay, so if you purchase any company's more than 50% shares, you will have control. Or you can acquire the selling company's all assets and liabilities directly. So if you acquire all the asset liabilities directly, then also you will have control. So these are the two ways in which you can obtain control. Control over what? Control should be over acquiree's business. Now, in case you remember in class, I gave you a detailed discussion on how the things will happen when you acquire control through stake or when you acquire control through assets and liabilities. So let's revise that part as well. So in case you acquire control through stake, if you are a parent company, okay, then you are the acquirer or purchasing company. So this parent company prepares two types of financials. One, it will prepare SFS, one, it will prepare CFS. SFS will be prepared as per Ind AS 27. Okay, so in SFS, what will the parent do? Parent will record investment in subsidiaries equity share to cash bank, because here you are purchasing more than 50% stake. So in SFS you record investment to cash bank. This accounting is done as per Ind AS 27. Leave it. Now parent will also prepare CFS. In CFS, parent combines the financials of parent as well as subsidiary. Okay. Now this CFS is prepared on day one also and on every year end also. It is just like once you marry, you will celebrate a marriage on the day of marriage, and also every year anniversary also you will celebrate. Same logic. So parent, once it comes into relationship with subsidiary, it will prepare CFS on day one also and every year end also. Now the CFS which you prepare on day one means on date of acquisition of control, the day you acquired the control. So CFS you prepare on date of acquisition of control will be prepared as per Ind AS 103. Will be prepared as per Ind AS 103, and the CFS that you prepare on every year end is going to be prepared as per Ind AS 110. That is why Ind AS 103 and 110 are interlinked. But before studying 110, we should know what is Ind AS 103. Is this clear to everyone? Okay. This was about parent company. So in short, what is covered under 103? The CFS prepared by parent on date of acquisition is covered under 103. Neither SFS is covered, neither year-end CFS is covered. Do remember. Okay. What about selling company? Selling company will prepare its normal financials. It is not covered under 103. Now, if you acquire the control through acquiring all the asset liability, imagine you have acquired all the asset liability of the selling company directly. So when you acquire all the asset liabilities of the selling company, that selling company is closed. Now you are the only company which is existing. So in SFS or CFS, whatever you may call it, you will never record any investment in shares, because here you are not purchasing any stake. You are purchasing asset and liabilities. So whatever you purchase, you will directly record all the asset and liabilities of selling company. SFS or CFS, it is going to be the same in this case. Okay. Here year-end CFS will not be prepared. Why? Because selling company is closed now. So with whom will you prepare the year-end CFS? Okay. Chalo. So this was a good conceptual knowledge which we gained through this. Okay. Then, so this was definition of business combination. Now, there are two important terms here. First, you should obtain control. So, control we already discussed. There can be two ways of obtaining control, but a formal definition is given of control, which we will study in Ind AS 110. Okay. One more key term was that you have to obtain control over acquiree's business. So whatever company you are purchasing, okay, whatever company you are purchasing, let's say for example, AK Limited is purchasing Mukku Limited. So that Mukku Limited should be a business, should be a proper business. So let's say for example, AK Limited is acquiring Ajay Limited. Now Ajay Limited is a shell company. You know what is the meaning of shell company? Which has no assets, no liabilities. Okay, no tangible assets and nothing. It is only prepared maybe to move the money from here and there. Okay, so such shell company, will this Ajay Limited meet the definition of business? The answer is no, because for a business to be called as a business, it should be having three things: input, process, output. Input means all the tangible and intangible assets. Process means the workforce of that company, the techniques to use this asset or technique to run the business, and output means profits and dividends. So if a company has these three things, then it will meet the definition of business. So here Ajay is a shell company, not meeting the definition of business. So when AK acquires Ajay, it will not be called as a business combination. Why? Because on paper you are acquiring a company, but effectively you are not acquiring any business. Simple. Okay, sir. Let's proceed. Then, so elements of business we discussed. Then there is something known as concentration test. This we will revise at the end. Okay. Okay, sir. Then we talk about asset acquisition. Now, what is the meaning of asset acquisition? Sometimes you don't acquire the whole company, but you acquire a couple of assets of any company. Let's say, for example, I went to Chroma. I purchased a couple of assets from Chroma. So, purchasing a couple of assets is not as good as acquiring a business. When you acquire only few assets, this is not business combination, that is asset acquisition. The accounting of asset acquisition we have already covered under Ind AS 16, 38, 40. Okay, so we discussed one example here. Let's say for example you acquired land and plant and machinery. So whenever you acquire two assets, okay, it is possible that you might pay a common consideration for both of them. So let's say I acquired land and building and plant and machinery. I paid 24 CR combined for both of them. Now how to bifurcate between the two? So don't record the land and plant at fair value. No, we record on cost. But how to bifurcate the cost? So you will bifurcate the cost in the ratio of fair value. Because you have paid a common figure for both of them, how to bifurcate between the two? Bifurcate in the ratio of carrying amount. Sorry, bifurcate in the ratio of fair value, which is given. Clear? Also, if you incur any legal cost or any direct cost of acquisition for any particular asset, that direct cost of acquisition will be added in the value of asset. So let's say I incur any legal cost for registration of land, that will be added to the cost of land. Simple. Is this clear to everyone? Yes, sir. So this was asset acquisition. Okay, do remember. Now comes the main part of this chapter. That is accounting for business combination. That is accounting for business combination. Now what is the meaning of accounting for business combination? That means whenever you enter into a business combination, how will the purchasing company account for it? So we will look at the accounting from the point of view of purchaser. So purchaser will have to follow 6 steps. How many steps? 6 steps. Do you remember all the steps? Chalo. Without seeing, tell me one by one. First step, identifying the acquirer. Acquirer means purchasing company. Second step, determine the date of acquisition. Why date of acquisition? Because on this date only we will prepare 103. CFS as per 103. Third step is PC. Fourth step is INA, identifiable net assets. Fifth step is NCI. Sixth step is goodwill. Okay, let's discuss all the steps one by one. First step was identifying the acquirer. Who is the acquirer? The entity which obtains control is the acquirer. So let's say AK acquired Mukku Limited. So AK is the acquirer. Okay, there is one exception which we will discuss later on. That is reverse acquisition. Don't discuss it now. Let's proceed. Second step was determining date of acquisition. Which is going to be the date of acquisition? The date when you obtain the control is going to be date of acquisition. So let's say I acquired Mukku on 1st July. So 1st July is a date of acquisition. But in question, it is possible that in some theory question or it may be in MCQ, there might be multiple dates given that we discussed on 1st July. We entered into agreement on 1st August. Shareholders approved on 1st September. Okay, government approved on 1st October. There can be various dates. So which date will be date of acquisition? So there is no specific date. For that, you will have to check all the facts and circumstances. Okay, it will depend. So do remember that you cannot predetermine that this is the date when date of acquisition. This is the date when you obtain control. You have to read the whole question and check based on question to question. So for that, in case you remember, we did illustration number 8, 9, 10. You can also revise it again. Okay. So this was 2 steps. Identifying the acquirer, date of acquisition. Generic steps. Now comes the main step, that is calculation of PC. Now what is the meaning of PC? Whenever you acquire any company, you will give something, right? You will have to give something. So that is known as purchase consideration. Whenever you acquire a company, you will have to give some purchase consideration. Now in purchase consideration, what all things can you give? So some basic stuff will come. You can give cash, you can give shares, you can give preference shares, you can give debentures, you can give assets. If you give any of these, we will consider at fair value. Let's say for example, you give any asset in PC. Okay, the carrying amount was 100, but fair value was 150. So what will you say? How much worth PC did you give? So you will say you gave PC worth 150. So consider this at fair value. Okay, basic stuff. Then what else can come in PC? Something known as deferred consideration. Now what is the meaning of deferred consideration? A consideration which you will pay after a certain number of years, but 100% you will pay. Okay, that is known as deferred consideration. So if there is any deferred consideration, you will consider it at present value. In case you remember, in class we discussed an example also, okay, where we were supposed to give any payment after 2 years. 100% we will give, but we will give after 2 years. So that is deferred consideration. So you will include this in PC at present value. Okay, and in PC, remember, on day one you are not paying anything. So on day one it will create a liability for the purchasing company, provision for deferred consideration. Okay, acha, one more thing. See, now you are including in PC and present value. The PC part is over. Now what will happen with this provision in future? So you include at present value, but you have to pay 200 now. So from present value you have to go towards future value. That is known as unwinding. So on every year end you will also do unwinding. Unwinding will be done for 2 years. Okay, so it is just like we used to do the unwinding for provision for decommissioning. Same way you will do the unwinding here as well. Is this clear to everyone, guys? Yes. Chalo, let's proceed. So this was your deferred consideration. The next point in PC is going to be contingent consideration. Now what is the meaning of contingent consideration? Contingent consideration means we will pay something after a certain number of years, but only on fulfillment of certain conditions. That is known as contingent consideration. So what is the difference between deferred consideration and contingent consideration? In deferred consideration we will pay 100% after a certain number of years. In contingent consideration you will pay only on meeting of certain conditions. Okay, only on fulfillment of certain conditions. So that is the time you will pay contingent consideration. So if there is any contingent consideration, at what value will you include in PC? You will include at fair value in the PC. For this we discuss some examples also. Let's say I was going to pay 300 crores in cash provided selling company meets any target. Okay, so we will include at fair value. Fair value is nothing but a combination of present value and probability, but in exam it will always be given in the question. Okay, and again for contingent consideration you are not going to pay it today, you will pay it after a certain number of years. So that will also lead to creating a provision today. Okay, now one more thing, because you are including at fair value, the fair value can change on every year end. Your PC will not change. PC and love happens only once in life, that is on date of acquisition. Okay, so PC is calculated only on day one. You include at fair value on PC. But what will happen with this provision subsequently? What if the fair value changes? Okay, so I prepared a summary chart for you. First of all, you have to check what is promised in contingent consideration. If you have promised cash or variable number of shares, if you have promised cash or variable number of shares in contingent consideration, on day one you will include in PC at fair value, and on year end you will remeasure through PNL. But if you have promised to give fixed number of shares in contingent consideration, that means you said that if you meet the condition I will give more shares, but fixed number. So if you have promised fixed number of shares, in day one you will include on PC at fair value, but on year end what is to be done? You will not remeasure it. Nothing is to be done on year end. Okay, because fixed number of shares meets the definition of equity, and equity is never remeasured. Okay, do remember this part. So this was about contingent consideration. Based on contingency, one more point was discussed, and that was contingent payment to employee shareholders. Okay, now what is the meaning of contingent payment to employee shareholders? Let's say I acquired a company and I acquired one of its employee also. I told this person that if you work for me, I will give you 25 crores in cash. So is this 25 crores PC? The answer is no, because this is paid in the capacity of employment, because he will join me, he will work for me, that is why I will pay 25 crores. So this I am promising in the capacity of employment, not form part of PC. But if this was paid in the capacity of shareholder, if I paid this to Ajay because he was a shareholder, then it would have formed part of PC. Is this clear to everyone? Yes sir, absolutely clear. So this will come in your PC as well. Acha, do remember these board notes I will upload on my Telegram. You can join the Telegram, link is in the description. Okay, do remember. Next part, one last point which will come in PC is pre-combination SBP award. Now what is the meaning of pre-combination SBP award? So sometimes what happens is selling company had a SBP plan which was ongoing. So let's say it had plan from 1st April 19 which was ongoing. Now after, which was of 5 years. After 2 years, AK Limited acquired BB Virtuals. AK Limited acquired this selling company. Okay. So along with the acquisition of company, I acquired the SBP plan also. So I told BB Virtuals that now I will issue the shares under SBP to your employees. Okay. So now what happens is, for the first 2 years, BB Virtual had booked the expense, but for the remaining 3 years, AK will book the expense. Now what is to be done with this? So when you acquire the SBP plan of selling company, whatever is the pre-combination amount, pre-combination means whatever is the SBP expense prior to date of acquisition, that will form part of PC. Why it will form part of PC? Logic I'll try to give in seconds, but in class we discuss in detail. We will include in PC for the only reason because for the first 2 years expense was booked by BB Virtuals. Okay, that is a selling company. But shares for all the 5 years will be issued by AK Limited. So AK will say for the first 2 years I will make it part of my PC. So remember there was a formula here. What was the formula? You can see SBP awards divided into 2 parts, pre-combination and post-combination. In pre-combination you will say fair value of original SBP awards multiplied by expired period divided by total original vesting period or total revised vesting period, whichever is higher. This amount will form part of PC. Okay, and whatever is the balancing figure will come in post combination. Do remember, when you calculate the value of post combination, you will not take fair value of original award, you will take fair value of replaced award minus the amount you booked in pre. Whatever balance is there, this will not form part of PC. This is the amount that the acquirer will book over the remaining vesting period. Okay, so a point of caution is that when you are calculating pre-combination amount, you will take fair value of original SBP award. Okay, but you are calculating when post-combination amount, you will take fair value of replaced award. Not going into the logics, we discuss the same in class as well. Okay, chalo. Is this clear to everyone? Yes, sir. Acha, one more thing. Whenever you include the pre-combination amount in PC, so you are not paying any cash today, na? So it will lead to creating a SBP reserve. It will lead to creating a SBP reserve in CFS. Do remember that. Okay. Last thing is that if you incur any direct cost of acquisition for business combination, let's say for example, for acquiring a company, you incur any legal fees or something. If you are incurring any such cost for business combination, that will not form part of PC. It will be transferred to PNL. Do remember this much. Okay, so this was the whole discussion of step number 3. So finally, if I want to do the revision in revision as well, so revision within revision, so I will say in step number 3, cash, asset, shared debentures will come at fair value, deferred consideration will come at present value, contingent consideration will come at fair value, and SBP award pre-amount will come. Okay, okay, sir. Apart from this, one discussion is pending here, that is related to non-replacement award. We will revise that at a later stage. Just remember that if you are not replacing the SBP plan of selling company, that will not form part of PC. Okay, so let's say in the previous example, if I was not taking over the SBP plan, then no amount will come in PC. Just remember this much. Okay, chalo. Now we come towards step number 4, and that is identifiable assets and liabilities. So whenever you pay any purchase consideration in CFS, what will you record? See, what is 103 day 1 CFS? So in CFS, what will you record? In CFS, you will record all the assets and liabilities of the subsidiary. In CFS, you will record all the assets and liabilities of the subsidiary. But at what value will I record? So remember, I gave you a awesome summary for this. We discussed in detail everything, it is there, but now we will just refer the summary part. Okay, just remember here. Step 4, INA. Whose INA we will take over? We will take over the INA of subsidiary, or you can call it acquiree, or you can call it selling company. Okay, at what value will I take over? I will take over at fair value. Okay, but there are certain exceptions to this. First, exception of classification. When you take over any asset liability, you can change the classification as well based on the condition or date of acquisition. That is, if let's say for example in subsidiaries books it was shown under non-current, but when you are acquiring you feel that it will meet the definition of current, so in CFS you will record it current only, current asset or current liability, whatever it is. But in case of one asset, in case of one item, the classification cannot change, and that is in case of lease. So let's say for example, if selling company had any lease, we take over the assets, in that leased asset also come, so you cannot change the classification of lease. So let's say for example, selling company was calling it finance lease, so in CFS also we will call it finance lease. If selling company is calling it operating lease, in CFS also we will call it operating lease. Okay, so these were exception of classification. Then comes the exception of measurement. Okay, first exception is contingent liability. See, as per Ind AS 37, we never record contingent liability. But under 103, if it is a contingent liability where it is a present obligation arising out of past event where outflow is not probable, but amount or fair value can be estimated reliably. So this contingent liability, if it is not your own contingent, but you are taking this over from a selling company, you can record it in INA. Okay, so only once in your life you can record a contingent liability when you take this over in 103. Do remember. Okay, contingent liability in normal case you never record it, but if it is a contingent liability which is obligation not probable, fair value is you can calculate the fair value, you will record this in INA. Acha, in exam if nothing is mentioned and if the fair value of contingent liability is given, you will assume that you have to take this over in INA. Simple. Do remember, this is contingent liability and not contingent consideration. Lots of students make mistake by considering this in step number 3 PC. Arey baba, in PC we take contingent consideration. This is contingent liability. Okay, do remember the differentiation part. Okay. Next point is income taxes. Now, what is the meaning of income taxes? Remember, as per Ind AS 12, deferred tax used to arise. Why it used to arise? Because we will take over at fair value. This fair value becomes the carrying amount, and the old carrying amount of selling company becomes the tax base. So difference arises. So that deferred tax we have to adjust against goodwill. So to adjust against goodwill, let's make it a part of INA. This same with discussion in Ind AS 12 also. Do remember. Apart from this. Next point is employee benefits, assets and liabilities. So if there are any employee benefit, asset and liability, you will take that over as per Ind AS 19 values. Apart from this, if there is any non-current asset held for sale, you will not take over at fair value. You will take over at fair value less cost to sale as per Ind AS 105. Apart from this, if there is any indemnification asset, what is the meaning of indemnification asset? It simply means reimbursement asset. So you take over a liability. Selling company says that if this liability arises, I will indemnify that liability for you. So basically, I will reimburse it for you. So where you are taking over a liability, you will also record an asset because that liability is indemnified to you. So now, should I record this indemnification asset? If you are recording the liability, you will record the asset also. If you are disclosing the liability, you will disclose the indemnification asset also. Do remember. So it will have the same treatment as liability. If liability taken over and recorded, record the asset also. If liability taken over and disclosed, then disclose the indemnification asset also. Apart from this, if there are any SBP awards, this will form part of PC and not in INA. Reacquired rights. What is the meaning of reacquired rights? Remember, I gave you one example. I sold my franchise to Kishan. Okay. Then after certain number of years, I acquired Kishan Limited. So Kishan already had this franchise. So this franchise will come back to me again because I acquired this whole company. So my franchise comes back to me again. Reacquired rights. So if any such reacquired right comes to you again, you will take this over at fair value. Okay. Last but not the least, if there is any asset liability relating to operating lease in the books of selling company, parent will also take it over, but at what value? At fair value. In short, it will take over at fair value. So this was a step number 4, that is INA, identifiable net assets. Okay. Then we come on towards step number 5, that is NCI. What is the meaning of NCI? See, one thing I always remember, let's say we are taking over 75% stake of Shankar Limited. So AK becomes the parent, Shankar becomes subsidiary, and because you are taking over more than 50%, control comes to you. Okay. So even if your stake is 75%, your control is 100%. Okay. Do remember this. Control is never partial. It is either there or not there. So even if your stake is 75%, you control Shankar Limited 100%. Okay. So when you take over the INA, you take over 100%. But you have paid PC only for 75%. No? That means you are recording extra INA of 25%. That you did not acquire, still you are recording it. Why did you record 100%? Because we control 100%. So therefore in CFS we take over 100% INA of subsidiary, but PC we give only for 75%. So extra 25% INA which we record is known as NCI. So as soon as you debit the INA, you will create a corresponding credit in the name of NCI. Okay, how much will it be? 25%. So it is just like the stake that does not belong to you. Still you recorded it. That stake is known as NCI. Okay, where will NCI appear? NCI will appear in the equity side. So you will create a third heading. Equity had 2 headings already. Equity share capital, other equity. Now a third heading will come NCI. Okay, Acha. Now at what value shall I record the NCI? So to record the NCI, we have 2 methods. Okay, summary I am showing you. NCI can be recorded at fair value also, which will be given in the question, or you can calculate by number of shares held by NCI multiply by the fair value of per share, or you can also calculate by PSNA method, proportionate share in net asset method. Whatever is the INA, proportionately you can calculate NCI. If you calculate NCI by fair value, then whatever goodwill will come in step number 6, that will be full goodwill. Remember we discussed this. That will be full goodwill. What is the meaning of full goodwill? Full goodwill means that goodwill will belong to parent as well as NCI. Okay. But if you calculate NCI as per PSNA, goodwill which you get in step number 6, it will be partial goodwill. Partial means goodwill only belongs to parent. Sir, why full goodwill and partial? See, remember we did one example where as soon as we take the fair value of NCI, our goodwill increases. That means goodwill is increasing because of increase in NCI. That is why goodwill belongs somewhat to parent, somewhat to NCI. That is full goodwill. Okay. But when you took NCI at PSNA, goodwill did not increase. It stayed at the real amount. So it was partial goodwill. Only belongs to parent. Do remember. This was step number 5. Last but not the least, step number 6. That is goodwill / GBP. Okay. How will you calculate that? Here it is. So first you will take PC. Let's say you paid PC for 75%. Then you will take NCI for 25%. Then one more item will come. We will discuss it now. Less INA 100%. You will get goodwill / GBP. So do remember, whenever you follow step number 6, we always want to compare 100% with 100%. Remember this line? We want to compare 100% positive side with 100% negative side. Then you will get goodwill or GBP. If you get the positive balance, you will get goodwill. If you get negative balance, you will get GBP. Is this clear till here? Yes, sir, absolutely clear till here. Now, please remember this, that can also be a case of step acquisition. What is the meaning of step acquisition? Let's understand with the help of one example. So let's say on 1st April 11, AK Limited purchased 15% stake in Mukku Limited. For how much? For 10 crores. Okay. On 1st April 13, AK purchased another 60% for 75 crores. Now, if you look carefully, in the first 15% stake, did I obtain control? The answer is no. But as soon as I obtained the 60%, did I obtain control now? Yes. I have the 15% also, I have the 60% also. So when will you start preparing the CFS on day 1? So your day 1 date of acquisition will be 1st April 13. Okay. Now, today you acquired only 60% stake. Whatever stake you had before the 60% is known as previously held investment. Now what will you do? You will take PC only for 60%, whatever you acquired today, plus NCI. NCI won't be 40%. See, apart from 60%, you also have 15%. So NCI is only 25%. Okay. But you will also add one more item, that is previously held investment. Why will you add this? Because remember, we want to compare 100% with 100%. So add it, previously held investment. But at what value? Don't add at the value of 10 CR. You will add at the fair value on date of acquisition. So whatever is the date of acquisition, you will remeasure this previous investment on that date's fair value. So record at that fair value. You will get a less INA, you will get the goodwill amount. For previously held investment, remember two things. Okay. First, we will consider it in step number 6 at fair value on date of acquisition. Acha, also one more thing you can do, which ICI also does, is that this previously held investment you can also include in PC. That is step number 3. Okay, that also you can do. You can add in PC also. If you take total PC, then you no need to write here. You can write both ways also. Okay. Anyways, we did in the question also. You can refer the solution also that question. Next, when you record the previously held investment at fair value. So let's say you acquired this investment at 10 CR. Now the value is 17 CR. There is a gain now. That gain will be recorded in CFS, in profit and loss, or OCI, depending on the category of investment. Okay. But this is only a theoretical part, not much relevance from question point of view. Okay. But you need to remember this. Last point under this 6 steps is GBP. If you total up PC plus NCI plus previously held investment minus INA, and you get a negative balance, that is GBP. For example, let's say you paid PC for 100%, 90 CR, less INA was 110 CR. So you are acquiring company worth 110, but only paying 90. That means you are acquiring the business at a cheaper price. Okay, that is the case when GBP will come. So this is going to be very rare. First of all, standard identifies the fact that this is going to be very rare. So if still you get a GBP, first you have to identify the reason. Why did you get this GBP? Identify the reason. If reason is clear, this GBP will first be recorded in OCI, then you will transfer it to other equity capital reserve. But if the reason is not clear, then directly transfer to retained earnings, directly transfer to other equity capital reserve. Okay. Do remember, under GBP, there is no need to classify it as full or partial. Clear with this? So this completes our 6 steps. Again, I will revise it. First, acquirer. Second, date of acquisition. Third was PC. In PC, what all things can come? Cash, shares, asset, debentures at fair value, deferred consideration at present value, contingent at fair value, and pre-combination SBP. Okay. If there is any direct cost of acquisition, don't form it part of PC. Fourth point was INA. INA we will take over at fair value. Some exceptions were there. Do remember that. Step number 5 was NCI. NCI, why it will come? Because we acquire 75%, but we record INA of 100%. So that extra what we are recording is NCI. NCI we have two methods: fair value, PSNA. Fair value full goodwill, PSNA partial goodwill. Step number 6 is goodwill GBP. PC plus NCI plus previously held investment minus INA will give you goodwill. Goodwill can be full or partial. If you get a negative balance, it will be GBP. GBP cannot be full partial. GBP we will record under capital reserve other equity. Simple, that's it. So revision within revision. Okay, so these were the 6 steps. Then in case you remember, we moved on towards certain questions. So first question which you can see was, I guess, illustration number 41. Let's do that question very quickly. Okay, because the what you can say unique feature of FR with AK is that we revise questions as well. Okay, so if see, I'm just doing the revision of question. So if you have not done this question, then just listen and you have to practice this. Okay, do remember, revision of question is not a replacement of writing practice. Writing practice you have to do, but when you revise the question with me, it will save a lot of time for you. You will remember the key adjustment also. Okay, so now illustration number 41, what does it say? So it says we have 25% stake previously, which does not give us control. We obtained more 65%, further 65%. So total becomes 90%. NCI will be 10% now. Okay, consideration information is given. Normal PC is given. Contingent consideration is given. It will come at fair value. Transaction cost will be transferred to PNL. NCI fair value is given. So if NCI is at fair value, goodwill will be full goodwill. Okay, also previously investment fair value is given. INA is given. Find the determine the accounting under acquisition method. So simply follow all the 6 steps. How will you follow it? So it is very simple. Step number 1, identifying the acquirer. Step number 2, date of acquisition. Step number 3, PC. In PC we give cash, shares, contingent consideration. It will come at fair value. It was given in the question. Okay, then previously investment. Remember I told you what ICI does is it makes it a part of PC. So you can show separately now. For 65% how much did we pay? For 25% how much we are paying. Okay, at fair value and date of acquisition. Total PC is this much. INA, then NCI. In goodwill also I am showing separately. I am showing PC of 64% separately. I am showing previously investment separately. Then add INA, add NCI less INA, you will get goodwill. It is full goodwill. Bifurcation was not asked of how much belongs to parent, how much belongs to NCI, so I have not given it. Okay, this was a simple question which can come in exam. Please do crack it. Okay, apart from this we have one more question, and that is illustration number 49. Again a very simple question, still we will refer it. Okay, come. See, you will understand the value of this revision once you study from me, and then after maybe 3 or 4 months when you open the books, when you feel that you will not recall anything, and when you watch this revision lecture, it will be a boon for you. I can promise this to you. Okay, so please make proper use of this revision lecture. Okay, it is my guarantee that you will thank me. I should not say that, but you will thank me. You can take this in writing. You will be like, sir, we are able to recall things. Okay, chalo. Anyways, illustration 49, what does it say? So it says that ABC acquired JKL. How much? 75%. Okay, so if we acquired, now JKL is a subsidiary, ABC is the parent. So shares of JKL are given. Share capital of JK is given 1.2 crore. Out of 1.2 crore, how much are we acquiring? 75%. 24% belongs to NCA. Then information is given for PC. So this information is for PC, where we are giving shares in the ratio of 2/3. Okay. Now the confusing part is they have given the fair value of both the company shares. So do remember, PC is given by whom? PC is given by parent. So in PC, you will multiply by the share price of parent. So when you take step number 3 PC, 2 mistakes you can make. First, when you give PC in shares, and where they have given the ratio that you will give 2 shares for every 3 shares. So take the total shares of subsidiary. Don't do directly 2/3. First, write that multiply by 75%. Why 75%? Because you have acquired only 75% of that company. Okay, so you will first multiply this number of shares by 75%. Then do 2/3 and then multiply by the share price of purchasing company. Okay, you will take your purchasing company. Do remember that. Okay, sir. You will get the PC in shares. Then what was there? Then after 1 year, you will pay something known as 71.5. So this was deferred consideration. Take at present value. Okay. Apart from this, we also promise some contingent consideration. We will take over at fair value on date of acquisition. So fair value was 2.5, whatever it is. We calculated this, the total PC we get it. So here also we are following 6 steps. Identifying the acquirer, date of acquisition, PC. Till PC it is done. Then next it is given that INA. INA's carrying amount is given, INA's fair value is given. We will take over at fair value. But tax rate is also given. Whenever tax rate is given, do remember deferred tax will also come into picture. Okay, it will also come like this into picture. Okay, so if you are taking over an asset at fair value, you will record at fair value. One sec. You will record at fair value this asset. Okay, now because tax rate was given, deferred tax will also arise. How much? See, your fair value becomes the carrying amount in Ind AS 12. Your old carrying amount, remember, old carrying amount of 6 CR is given, that becomes a tax base. Difference of 1 CR will come, deferred tax of 0.2. Make it a part of your INA. So this will become part of your INA. Okay, then NCI. Here in question it was mentioned that you will calculate NCI as per both the methods. So you will have to follow both the methods. First is fair value and next is PSNA. If you read the whole question, fair value of NCI was not given. How will I calculate the fair value of NCI in that case? First, we'll have to see the number of shares held by NCI. So if out of 1.2, I had 75% shares, so 25% of this 1.2 CR shares will be with NCI. Okay. So 25% you can do. Multiply by NCI will have whose shares? NCI will have parent company's share or subsidiaries company share. NCI will have the share of subsidiary company na, because in subsidiary company I have 75%, NCI has 25%. So multiply by the share price of subsidiary. You will get the fair value of NCI. Either this or you can follow PSNA. In this question it is said to follow both the methods, so I am doing by both the methods. Then you will get the goodwill slash GBP. So if you take NCI at fair value, goodwill will come at full goodwill. If you take NCI at PSNA, goodwill will come at partial goodwill. And in the question, one last information was mentioned that whatever goodwill you get, you will have to do 10% impairment. So reduce the goodwill by 10%. So under both the circumstances, you will reduce by 10%. Simple. This was the question. This was illustration number 49. Okay. Clear with this illustration? Acha, do remember, whenever I revise some questions in a revision lecture, I am not revising all the questions which this chapter might have. I am taking up those questions which cover 100% of the concepts. So let's say I took up this question. Can I say it covers your basic calculation of 6 steps? I took the previous question, illustration number 41. That also covered basic calculation of 6 steps, right? That is how you should study. In first instance, you can study everything, but you need to keep on marking what to take this, how much to take in your revision. Okay, because you will be able to retain only whatever you study during those revision days. That is important to concise the content. I am helping you in that. Okay, so you can use that. Apart from these questions, if you have done any questions previously and you felt that those were also important, you can refer them as well. Ideally you should. Okay, chalo. Now next question which we will take is illustration number 40. My favorite question, even ICI's favorite question. What is it? So here two companies are there, Professional, Dynamic. So here Professional Limited acquires 70% of Dynamic Limited. Okay, so Professional becomes the acquirer, Dynamic becomes the acquiree. Okay, so if we are acquiring 70%, NCI will be 30%. Here also we are giving shares. How much? 1 share for every 2 share. So here also what will you do? First take the shares of Dynamic. Okay, only acquire 70% of it. Only acquire 70% of it. Okay, and then do multiply by the ratio of 1/2. Okay, so we will say Dynamic had 4 lakh shares. Dynamic is the selling company. Selling company had 4 lakh shares, out of which we got 70% in the ratio of 1/2, and the shares which we are giving has a fair value of 40. So we will again multiply by how much? Multiply by 40. Okay, so we will get this PC in shares. Acha, do remember, PC is been given by Professional Limited. Professional Limited's face value is only rupees 10. So out of this 40, 10 worth will be face value, 30 will be premium. So you can also give the bifurcation of face value and premium. Okay, so this was the first part which came in PC. Then information is given that the fair value of PP is this much, so this will impact your INA. Only PP's fair value is given. Other asset liabilities fair value is not given. So for other asset liabilities, you will assume that fair value is same as carrying amount. Okay. Then the most important adjustment of this question is that B part, this one, where it says Professional Limited also agreed to pay an additional consideration that is higher of 35 lakhs or 25% of excess profits. So when it says it is higher of 35 lakhs or this much, can I say minimum 35 lakhs you have to pay? So by reading this, you might feel it is contingent consideration, but no, it is deferred consideration. Why? Because when you say higher of this much and this much, 35 lakhs definitely will have to pay. Even if this 25% of excess comes to nil, still you have to pay the 35 lakhs. So this is deferred consideration, because in deferred we say we will give 100% but after a certain number of years. Okay, and also one more thing, one smart hint I gave you. What was the smart hint? In deferred consideration we take at present value now. So for that, discounting factor will be given. If it would have been contingent consideration, fair value should have been given, which is not given here. Okay, contingent consideration fair value is always given in the question. If it is not given, it is not contingent consideration. Do remember. Okay. So deferred consideration also forms part of PC. That is also done here. Okay. Next point is that we also pay one of the founder shareholder for staying in employment. So this is not PC because it is contingent payment to employee shareholder based in the capacity of employment, not from part of PC. Then pre-combination SBP award. So we will do the calculation, whatever amount comes in pre, we will make it part of PC. So you got a total PC. So step number 1 was acquirer, it is professional. Step number 2, date of acquisition, this. Step number 3, PC. Then step number 4, now let's read the remaining adjustment also. Remaining adjustment says 1 is that there is a contingent liability worth 5. So we will take this over in your INA. Then tax rate is given. So even deferred tax will come in INA. Okay. What is required? CFS is required. We will do it. Don't worry. How will I solve it now? Step number 3, PC is done. Then I will take step number 4. INA. INA, whose INA? Subsidiaries INA. Take over at fair value. So the assets for which fair value is given, take at fair value. The asset liabilities for which nothing is mentioned, take at carrying amount only. Okay, we took this over. Apart from this, a contingent liability worth 5 will also come and deferred tax will also come. But deferred tax will only come for those assets whose carrying amount and fair value was different. So only for PP and contingent liability, it is different. For PP, this was the carrying amount, that is the new fair value, and the old carrying amount which becomes the tax base was this much. For contingent, it was not recorded in selling company's book. So old carrying amount was 0, new fair value is 5. So create deferred tax, I get a DT of 46.5 recorded. Step number 5, NCI, nothing is mentioned, we will use PSNA. In NCI, do remember first preference we will give to fair value, nothing is mentioned about it, use PSNA method. Okay. Then step number 6 is goodwill or GBP. PC plus NCI minus INA, we are getting GBP here. It will form part of your capital reserve other equity. Now we have to prepare the balance sheet. So first look at a draft of the balance sheet. How is the balance sheet prepared? As per schedule 3, start with assets. In assets, we will record the assets of parent as well as subsidiary. Parent's asset, you will keep at carrying amount only. Subsidiary's assets, you will take over at fair value. Goodwill, if any, don't forget to record it. Then equity and liability. In equity, we have equity capital, other equity. This too will only come of parent. Why, sir? Because in CFS, we record the asset and liability of subsidiary. Only asset and liability of subsidiary, not equity capital, other equity. Okay. So we will, in capital and other equity, you will only show of parent. Okay. One extra item will come in equity, that is NCI. Okay. Then liabilities are there. Liabilities, same logic like assets. Parent state carrying amount, subsidiary recorded fair value. Key points in this balance sheet are going to be whatever PC you are giving in a business combination, that PC will impact your balance sheet. So let's say you gave shares, capital will increase. Let's say you give cash balance will decrease. Okay. Let's say you gave pre-combination SBP award, other equity will increase. Are you understanding? Let's say you promised deferred consideration, liability will increase. So PC effect should come in balance sheet. Also, don't forget to record goodwill GBP in CFS. Likewise, we prepared. See, balance sheet is something which you have to practice. Then only you will understand. So if you can see PP in investment, we wrote it. DTA we did not record because in balance sheet, DTA, DTL net is shown. DTL was already there in the old balance sheet. So, and it was higher than DTA. So in net, we will show DTL. Okay. Then other assets are shown. Then for equity, capital will only come off professional, and whatever shares you gave up to face value will come in capital. Whatever premium was there, it will come in other equity. Okay. Then other equity, what all things will come? Professionals, other equity will come. Dynamics, other equity won't come. Professional, other equity, premium, SBP reserve, which was there in PC, and GBP will come. Okay. This you will come with practice. This you will remember only with practice. Don't try to ratify this. Okay. Then NCI will come. We already got the value of NCI in step number 5. Then balance asset liabilities. In this, don't forget 2-3 items. First, whatever deferred consideration was there, you are not paying it today. It was leading to a liability creation today. So liability will increase. Okay. Then DTA, don't forget to adjust it with DTL. Okay. And then contingent liability at fair value ₹5, we will record it. Do practice this question. It is a very good question. Okay. Then we moved on with the another point that was known as measurement period. Now, what is the meaning of measurement period? Standard identifies the fact that it is not possible to calculate all the values on date of acquisition. So it is possible that certain items you won't have the exact fair value date of acquisition today. So for that, we will record initially at provisional amount. So let's say I took over 75% of Ritik Limited. Okay. INA at fair value was 1100. This is the provisional amount. I don't know the exact amount. Okay. Now PC was 75%, this much, NCI at PSNA. Now, when you solve this, you will get the goodwill. Okay. And NCI is also based on PSNA. So you will get the NCI also. Now what happens is, what is the concept of measurement period? Standard gives us a grace of 1 year. If you get the information within 1 year, and if that information relates to date of acquisition, two criteria, huh? First, if that information relates to, if that information received within 1 year, and if that information relates to date of acquisition, if these two conditions are met, then whatever is the information received within measurement period, your goodwill will be impacted. Let's say, for example, on 14th Feb, the love day, okay, the lovey-dovey day, okay. So if on this date, you get the information that the real INA was 1200 crores and not 1100, so can I say your INA has increased? So this will directly impact your goodwill. Okay, so if INA increased, you will debit INA by the amount of increase. Okay, but if INA increased, can I say even your NCI was based on PSNA, so even your NCI will increase. Okay, so if your INA increases, NCI will also increase by 25%, balance will be adjusted against goodwill. This entry you will pass on 14th Feb only. Do remember this. Okay, this entry will pass on 14th Feb. Measurement period adjustment. This I have directly discussed. Acha, what if your NCI was based on fair value? What if the NCI was based on fair value? In that case, if your INA increases, NCI won't change. Directly full amount will be adjusted against goodwill only. Okay, so if you want to refer the measurement period summary, one sec, I will revise the measurement period summary with you as well. You can see here, if the information was obtained within 1 year and if it relates to date of acquisition, then the effect will be against goodwill, and also if NCI based on PSNA, your NCI will also change. Acha. What if the information is received within 1 year but does not relate to date of acquisition? Then you will adjust through PNL. Don't change goodwill. What if the information received after 1 year? Don't change goodwill. Transfer it to PNL. Simple. Okay. Now based on this, one more question which we revised was illustration number 52. My favorite question. Okay. Chalo, let's do this. Come. Illustration number 52. Here it is. My QD favorite question. Have a look here. So here H acquired S. Okay, in two tranches. First we acquired 15%. Through 15% we don't get control. Then we acquired 45%. Of course we got control now. Okay, so total stake became 60. NCI stake is 40. Okay, now the balance sheet of subsidiary is given. Carrying amount is given. Fair value is given. We will take over at fair value. But there is one item. Non-current asset held for sale. For this, we don't take over at fair value. We will take over at FVLCTS. Okay, do remember. Acha, please do one rectification. For cash, the carrying amount and fair value both are 4 only. Typo mistake. Anyways, then other information was given. So first information was relating to contingent liabilities. So always whenever any adjustment is given, first back of your mind should come which step it will impact. So it will impact my step number 4. Okay. So there are two contingent liabilities. One is worth 0.5, one is worth 2. We will take over both in INA. But now comes this part. For this 0.5, it is mentioned that this amount will be tax deductible. So deferred tax will also be created on this 0.5. But for this 2, the question is silent. So if it is logical also, if in one case it is given specifically, if in the other case it is silent, that means in the other case, on this 2, deferred tax impact should not come. Okay, you can also create it, but it is a hint which is given by the question. In one case, they are mentioning about deferred tax, so create it. In one case, they are not mentioning, so don't create it. Okay, so on this 0.5, deferred tax impact will also come. On this 2, it will not come. Apart from this, the indemnification asset also, you will take this over in INA step number 4. It is mentioned it is not taxable, so no deferred tax on indemnification asset. For non-current asset held for sale, it says value of 4 CR is FVLCTS. So can I say this 4 CR is carrying amount also is FVLCTS also? Okay, so we will take over at FVLCTS. Anyways, let's proceed. Then information of PC is given that we are giving PC in the ratio of 1/2 and the value of share is 10,000. So PC initially you will not give for 60%. You will give only for the 45% because you are acquiring now 45% only. So how will you do it? First, calculate the number of shares. You are acquiring 45% today in the ratio of 1/2 and the shares given by you are worth 10,000 each. You will get the PC in shares. Okay. Then you are also giving some cash in PC. So that cash also will come. It is mentioned here about cash. Okay. So that cash also will come here. Apart from it, you are also giving contingent consideration. Now for contingent consideration, question gives 2 value. Okay. One value it is giving for date of acquisition and one fair value of contingent consideration is given on year end. In PC, we will take over at the fair value and date of acquisition, that is 22 CR. Okay, so we'll take a 22 CR. We got the PC amount as per 45%. Then information of share price subsidiary is given. Why it is given? To measure a previously investment. 15% you had na previously. This 15% you will measure at the fair value on date of acquisition. So out of this middle value is relevant for you because this is the date of acquisition. So you will get the value of previously held investment also. Okay. Then INA. For INA, information was already given in the balance sheet. Take over everything at fair value. Apart from this, non-current asset held for sale. Take over at FELCTS. Okay. Liabilities. Remember two liabilities 0.5 and 2. Take this over. Indemnification asset. Take it over. Then deferred tax will also come because if you read the question till the end, tax rate was given. So indemnification asset will also come. Deferred tax will also come. Deferred tax will be created only on those assets whose carrying amount and fair value is different. So here the old carrying amount becomes tax base, new fair value becomes carrying amount. Okay. So for these three assets, they were different. These initial three, they were different. For contingent of 0.5, we will create, but for contingent of 2 and indemnification of 1, don't create it. Okay, so basically we are just following the 6 steps. Step number 1, acquirer. Step number 2, date of acquisition. Step number 3, PC. Step number 4 is INA. We are doing that. Step number 5, NCI. In the question part, it is mentioned that for NCI, you have to follow PSNA method. We are not assuming this, it is mentioned. So as per PSN, you get the NCI. Okay, then you will get goodwill GBP also. Okay, in simplistic way, you will get goodwill GBP as well. Now, the first part was to calculate goodwill GBP. Follow the 6 steps, you will directly get it. Follow the 6 steps, you will directly get this. Okay. Apart from this, one more thing was asked. What was asked? Will the amount of non-controlling interest and goodwill change subsequent to 31st March 17? So I missed this information on purpose. There was one information for measurement period. It is said that we received some information 31st May and that relates to date of acquisition. This information was that an INA of 0.35 is also existing, which we came to know within 1 year, but it relates to date of acquisition. So will this be adjusted in goodwill? The answer is yes. So just pass a entry for this. So your INA will come 3.5. Okay, because NCI is based on PSNA, 40% NCI will change. Okay, balancing figure goodwill will change. Okay, why did I adjust this through goodwill? Because it was received within measurement period and it relates to date of acquisition. Do remember this entry we will pass on 31st May. Don't consider this in the step number 4. Huh? Step number 4, we are following on date of acquisition. On that date, we don't know about this. So don't consider this 3.5 there. Okay. Apart from this, there are also certain customer relations given. Okay, but this customer relation does not relate to date of acquisition. They are arising after it. So that will not be adjusted against goodwill that I have mentioned here. Apart from this, there is third part of the question also. It is saying that what will be the accounting treatment of contingent consideration? Remember, we discussed this. Contingent consideration, if it is promised in cash or variable number of shares, on year end, we will remeasure it through PNL. So day 1 included fair value in PC, done. Now in this question, it was promised in cash. So we will remeasure it. On first day, it was worth 22. Now it is worth 23. There is an increase by 1. So your provision is increasing. So you will credit the provision and debit profit and loss. Okay. So this was a illustration number 52, which we did as of now. So if I want to show you the chart, what all concepts along with the big questions we have covered, I will show it to you. One sec. Just give me a moment. So if you come to see this, we have covered definition of business combination, this control point we discussed, business element of business is done, asset acquisition is done, then accounting for business combination, all 6 steps along with the big questions we have completed the revision. Of course, now we will continue with the balance revision as well. But till now, whatever we revised, I hope this was helpful for you. I hope you understood this. Okay, balance part we will revise in the next part, of course. Okay, so I hope this was helpful. Thank you. Take care. So guys, let's continue with our revision of Ind AS 103. I guess in the initial part we revised till illustration number 52. Okay, so that was our normal 6-step accounting which we did. Now let's move on towards the revision where we are going to revise this part, that is common control transactions. Now what is the meaning of common control? In case you remember in common control we discussed the same in the notebook. What does it say? So we have a parent company which has 4 subsidiaries, P, Q, R and S. Okay, now who is controlling these 4 subsidiaries? Of course, AK, the parent, is controlling these 4 subsidiaries. Now just imagine that what if this P takes over Q? So the hierarchy will be something like this. AK will have 3 subsidiaries and under one subsidiary there will be a subsidiary. Okay, But can I say still, even after P takes over Q, Q is ultimately being controlled by AK only. Why? Because the parent of Q is P and the parent of P is AK. So even before the takeover, all the four companies were ultimately being controlled by AK. And after the takeover, all the four companies are ultimately being controlled by AK only. So this type of transaction is known as a common control transaction. Now, whenever it is a common control transaction, what should we do? Or how will we come to know whether it is a common control transaction? So there is a hint given. Okay, before and after takeover, the ultimate controlling party is the same. If this hint is met, then it is a common control transaction. Now, if anything is a common control transaction, what should be our accounting? So the accounting for common control transaction, I have tried to simplify this in 6 steps only. In normal business combination, we gave 6 steps. Here also I'm giving 6 steps. The only difference is here the steps are a little bit different. First, identifying the acquirer. Here the acquirer is going to be P Limited because who took over Q now? P took over Q. But the ultimate parent is AK. Anyways, who will follow the common control accounting? P will follow the common control accounting. Step number 2, date of acquisition. Step number 3, PC. Now please remember, in case of common control, if you give shares, you will not give shares at fair value, because you can imagine in common control there is no transfer of control. So here we will always give anything at face value only. So if you give shares, you will issue at face value. Acha, what about any other mode of PC? Normally in common control, we don't give any other mode of PC. But if in question it comes, you will take it normally. Normally means what we discussed in the normal 6 steps. If there is deferred consideration, take at present value and whatever it is. Okay, that everything else will remain the same. But if you give shares, issue at nominal value. Okay, do remember in case of common control, normally this will only come. You will issue you will issue shares only. Apart from this, step number 4, INA of subsidiary. When you take over the INA of subsidiary, at what value will you take over? You will take over at book value. Along with the INA of subsidiary, you will take over one more thing, that is reserves of the subsidiary. So in common control, we issue the shares at nominal value. We take over INA and reserves both at book value. Okay. NCI here is not applicable. And step number 6, because there is no transfer of control, there will be no goodwill GBP. Whatever difference comes either on the debit side or on the credit side, it will be transferred to capital reserve. Okay, so this was the basic concept of common control. So do we have a question on this? Definitely we have a question on this, but that question we will solve once we are done with one more concept, and that is demerger. Okay, so now let's revise what is the concept of demerger. Acha, before revising, do remember in demerger also there can be 2 types. It can be demerger under common control or demerger not under common control. Okay, it can be demerger under common control or it can be demerger not under common control. Sir, how we will come to know whether it is demerger under common control? So remember, I gave you 2 hints. Okay, when will it be called demerger under common control? First, in the demerged company. Demerged means, let's say for example, Ajay has 4 divisions, AK, BB, SK and XY. Now let's say Ajay is transferring one division to a new company. So this Ajay Limited becomes demerged company and the new company becomes resultant company. Okay, I've mentioned it here. So if the demerged company has a major shareholder, so if you ask me who was the shareholders in Ajay, so I said Kishan had 90% shares, Hema had 10% shares. So was there a major shareholder in Ajay Limited in the demerged company? Yes. So this is the first condition. Demerged company should have a major shareholder. Second condition is that resultant company, if they give any form of PC, the PC should be in the form of shares. Okay. If both the conditions are met, then it is demerger under common control. Again, I'll repeat. The demerged company should have a major shareholder. Second, the resultant company, that is the new company, which is taking over the new division, which is taking over the division from demerged company, should issue PC in shares. If both are met, then it will be demerger under common control. If either of one condition is not met, or if both are not met, then it will be demerger not under common control. Let's say for example, I took example number 2, wherein Ajay Limited there were so many shareholders, there was none of the major shareholder present. Okay, so it is demerger not under common control. Or if there was a major shareholder but the PC was given in cash, then also it is demerger not under common control. Do remember that. Sir, what difference does it make? In case of demerger under common control, the accounting is different compared to demerger not under common control. Now, what is the accounting? It is very simple. Demerger is the only case where you will pass the entries in both the company's books. Normally, in case of Ind AS 103, we pass the entries only in the books of purchasing company. But demerger is the only case where we will pass the entry in both the company's books. Okay. So, what entry will come in the books of acquiree? that is the demerged company. Okay, so acquiree for acquiree division is going out, so it will remove the liabilities, it will remove the assets. Okay, difference will go to capital reserve. Do remember, acquiree will not record the PC of inflow. Why sir? They are receiving the PC now. PC is not being received by the demerged company. It is being received by the shareholders of demerged company. So it will not record the inflow of PC. Do remember this much. Okay. So liabilities outside, asset will go out at carrying amount. Difference will be transferred to capital reserve. Now, because this is demerger under common control, whose accounting will be affected? Acquirer's accounting will be affected. Let me give you a hint. It may be demerger under common control. It may be demerger not under common control. Accounting of acquiree is same in both the cases. The difference comes in the accounting of acquirer. Why? In case of under common control, we discussed now, we will take over everything at book value. We will issue the PC at nominal value. Okay. And the difference, if it comes, won't be transferred to goodwill GBP. It will be transferred to capital reserve because this is demerger under common control. So you will issue the PC at nominal value, take over the asset at book value. Difference will go to capital reserve. Simple. Okay, do remember that. Acha, in case of demerger, you will also say one thing, sir, it is under common control now. So why not take over the reserves? In case of demerger, do not consider reserves. But sir, you said in common control, reserves are considered. Only in case of normal common control question, we will consider reserves. But in case of demerger, do not consider reserves. Okay, chalo. Now, what if it is demerger not under common control? The accounting of acquiree is same. Liability outside, asset outside, difference capital reserve. Okay. Do not record the inflow of PC. What about acquirer? What about acquirer? Because it is not under common control, acquirer takes over everything at fair value. Okay, they will issue the PC at fair value if it is any. Difference will be transferred to goodwill or GBP because it is not under common control. So normal acquisition accounting will be followed by acquirer. Okay, do remember, in case of demerger, NCI is not applicable. Simple. So this was the case of common control and this was the case of demerger. Now we will revise some questions based on common control and demerger. Okay, so the first question which was there was illustration number 36, I guess. Okay, chalo, let's revise this question very easily. 36 talks about a company, Enterprise Limited, which has two divisions, laptop division, mobile division. Okay, now what is happening is they are removing the mobile division. I'll just simplify this for you. Okay, so it has been transferred to Turnaround Limited. Now we want to check by reading this paragraph whether it is demerger under common control or is it demerger not under common control. So if you see, the PC are being given in shares and there is a major shareholder. Because both the condition are met, it is demerger under common control because PC in shares and there is a major shareholder in which company? In the demerged company. Now what was asked? They have asked the accounting in the books of Enterprise. Enterprise is the acquiree. It is a demerged company. What would Enterprise do? It will remove the assets, remove the liabilities. So what is Enterprise doing? See closely. Removing all the liabilities at carrying amount, removing all the assets at carrying amount. Difference is being transferred to capital reserve. Okay. Then they have asked the balance sheet of Enterprise Limited. How will you prepare the balance sheet? It is very simple. Just remove the mobile division. Only the laptop division will remain. Prepare the balance sheet of this laptop division. Only one extra point will come because when you were removing the mobile division, a capital reserve arised. Don't forget to take the effect of this capital reserve here. That's it. Okay, simple. Then they have also asked the balance sheet of Turnaround Limited. That is the new company. In case of turnaround, do not directly prepare the balance sheet. First pass the entry. What is turnaround doing? It is a case of demerger under common control. So take over the assets, take over the liabilities. Issue the PC at face value only. Why face value? Because it is demerger under common control. So issue at face value. Record the asset, record the liability at book value. Issue the PC at face value. Difference will be transferred to capital reserve. Now just prepare the balance sheet. Whatever assets you recorded will appear in balance sheet. Whatever liabilities is there will appear in balance sheet. Issue of PC will impact your equity share capital. Whatever capital reserve you got will impact your other equity. Of course, see, these are some things which I'm only revising, but you will get very foolproof with this only when you do written practice of it. Okay, do remember. Chalo. The next question was illustration number 37. Okay, illustration number 37. Similar question, what does it say? Maxi Mini Limited has two divisions, Maxi and Mini. So I'll just simplify this for you. They are removing the Mini division. They are removing the Mini division. Okay, and transferring it to Mini Limited, a new company. Okay. In PC, they are giving shares, but there is no info of any major shareholder. So because there is no info of major shareholder, you can assume it to be not under common control. But there can be also one assumption. If you say that no sir, even if it is not mentioned, I will assume that there was a major shareholder. So in that case, you can assume it to be under common control only. Okay. Here the information of any kind of fair value is missing, so under both the alternatives, even if you assume under common control, even if you assume not under common control, under both the alternatives answer will be the same. Okay, but still I feel if the information for major shareholder was missing, you can assume it to be not under common control, but ICI has assumed it to be under common control. Okay, so you can assume it any which ways. For this question, the answer will come same in both the methods. Okay, do remember. Chalo, now what is there? 37. So first I have assumed demerger under common control, but ICI assumption is demerger, sorry, not under common. I have assumed ICI's assumption is demerger under common control. But in this question, solution under both the methods will be the same, as INS fair value is not given. Okay, do remember. And PCR also issued at face value in this question. Anyway, so now what is asked? In the first part, they have asked the entries in the books of Maxi Mini and also the balance sheet of the two companies. So how will the entry come? Maxi Mini, the old company, remove the liabilities, remove the assets, difference capital reserve. The new company, record the asset, record the liability, issue the PC, difference GBP or goodwill or capital reserve, whatever it is. I am using the word GBP because I had assumed not under common control. If you are taking ICI's assumption, you can write only capital reserve here, because in that case GBP goodwill won't come. Okay, yes. Next part, balance sheet of Maxi Mini. Now when they have asked the balance sheet, they have also asked the comparatives corresponding previous year's figures. What do you mean by previous year? Previous year means before demerger figures. So in the old company books, in the books of Maxi Mini, what will be the figures of before demerger? Simple. Before demerger, can I say they had both the divisions? So take the use of this total column. Okay. So before demerger, everything was there in totality. Okay, we just did it. After demerger, Mini division is gone. Only Maxi remains. So just record the Maxi division. Don't forget to take the effect of the capital reserve which arose on demerger. Okay, so we did it. Done. Then they have also asked the balance sheet of Mini Limited before and after. Now Mini is a new company. So before demerger there was nothing. Only after demerger will come. Sir, what will come? We already passed an entry now. So record the assets, record the liabilities in balance sheet, issue the PC through capital. Difference will be capital reserve. Okay, so here it will be there. Assets, equity capital in PC, other equity, then liabilities. Done. Simple. Right? Now, I'm not solving this question for the first part. First part was very much similar to what we did in the previous question. We are revising this question for the part B and part C. What is there in part B? In part B, it is said that the directors of two companies ask you to find the net asset value per equity share pre and post demerger. Now, what is the meaning of net asset value per equity share? So it basically means total net assets divided by number of equity shares. Okay, this is how you will find net asset value per equity share, but they wanted pre and post demerger. How will you find it? Chalo, first let's talk about Maxi Mini Limited. Pre demerger, how will you find net assets? So before demerger, check the net assets. 1000 minus 300. Net assets are 700. And number of shares is, capital was 50 crores. Face value was rupees 10. So number of shares will be 5 crores. So 700 divided by 5 crores, you will get rupees 140. This is your pre-demerger Maxi Mini value. What about post-demerger? Just look at the balance sheet, find the net asset. 500 minus 100, you will get 400. Divide by again the number of shares, same. So 400 divided by 5, you will get 80 rupees per share. What about Mini Limited? In Mini Limited, before demerger, there was nothing. Before demerger, there was nothing. Just look at after demerger. After demerger, it will say, again, check the net assets. Divide by the number of shares. You will get rupees 60. What is the interpretation of this part? We can say before demerger, only one company was existing and it had a value of 140 rupees per share. After demerger, it got splitted into two companies, Maxi Mini and Mini. The worth of one company is 80, the worth of one company is rupees 60. Still, the total worth is rupees 140 only. So as a shareholder, previously you had one share of rupees 140. Now you are having one share of 80 and one share of 60. Still the total value is 140. So the third part they have asked is, comment on the impact of demerger on shareholders' wealth. So can I say there is no impact on the shareholders' wealth? Why? Because still previously also he had one share of worth 140. Now he has two shares, but the total value is still rupees 140. So there is no impact on the wealth of shareholders. Okay. Okay, sir. This was demerger. The case of demerger. Now we talk about reverse acquisition. Now what is the meaning of reverse acquisition? I gave a very nice example in this. In case you remember, this is me and this is my wife. We both have 100 shares outstanding. Now let's say I acquired the company of my wife, 100%. So I issue PC, 2 shares for every 1 share. How much PC will I give to Mru Limited? So I will give for that 2 shares, for every 1 share I am giving 2 shares. 2 shares for every 1. So for 100 shares I will give 200 shares. Okay. Now can I say AK will prepare the CFS? In AK CFS, in case you remember, in equity capital, only parents number of shares will appear. Okay. So parents old shares were 100. in PC they issued 200 shares. So in totality they issued 300 shares. Okay, their issued capital was 300 now. How come? 100 was there from day one. 200 they gave in PC. So total became 300. Now if you see closely, out of this 300, 100 were belonging to AK only, but 200 were issued to MRU Limited. That means, can I say, out of 300 shares, 66.67% stake went to our own subsidiary company. This is reverse acquisition, where our subsidiary becomes the holding company, where our subsidiary has the majority stake. So it is a case of reverse acquisition. How to find reverse acquisition? It is very simple. Just prepare this rough working note. You will come to know about reverse acquisition. Okay. And why did this reverse acquisition occur? Because in PC, you gave more shares compared to what were there in originally in your equity shares. So originally you had only 100 shares, but in PC you gave more than 100 shares. You gave 200 shares. That is why it became a case of reverse acquisition. Okay. So of course it is intentional. When the company does it, it is intentional. So now how to account for the reverse acquisition? Step number 1, identifying the acquirer. Here acquirer from legal point of view was AK, but you need not find the acquirer from legal point of view. You need to find the acquirer from which point of view? Very good answer. You need to find the acquirer from accounting point of view. So from accounting point of view, here the acquirer is not AK. The accounting acquirer will be MRU Limited. Right? Okay. So here our step changes. So for reverse acquisition also I have given 6 steps. So for everything there is 6 steps. Okay. So in business combination you are feeling any issue? 6 steps. Okay. So first step is identifying the acquirer. First I will say from legal point of view AK was the acquirer, MRU was the acquiree. But from accounting point of view, MRU is the acquirer and AK is the acquiree. Right? Okay sir. Now forget what is happening from legal point of view. Forget the legal part. Just focus on the accounting part. On accounting part, who is the acquirer? MRU. So imagine what if MRU is the acquirer? What will happen? So step number 2, date of acquisition. It will be the same. Step number 3, PC. Now normally PC was given by AK to MRU Limited. But here if MRU is the acquirer, if MRU is considered to be the acquirer, can I say MRU should have given the PC? That is known as deemed PC or accounting PC. That is known as deemed PC or accounting PC. What is the meaning of this? If MRU would have issued the PC, how many shares will MRU give to maintain 66.67% stake? What is the meaning of this? It is simple. To find deemed PC, take the opening shares of MRU. Remember we discussed this. Take the opening shares of MRU, divide by the stake to be maintained. How did you get the stake to be maintained? We did the rough working note now, where we came to know MRU has got 66.67% stake. So take MRU's opening shares, divide by the stake to be maintained. Whatever answer you get, then again deduct the opening shares. You will get the accounting or deemed PC in terms of shares. 50 shares. Okay. This is nothing but the accounting PC. If MRU would have given the PC, she would have issued 50 shares. Multiply this by the company share price. MRU's share price, of course. You will get the PC in rupees. This is the most important calculation in case of reverse acquisition. Do remember this part. Okay. Chalo. Rest. Then step number 4. We take INA. Do remember when we talk about INA, normally we take INA of subsidiary. Here, which subsidiary are we talking about? Subsidiary from accounting point of view or subsidiary from legal point of view? Here we are talking about subsidiary from accounting point of view. Who is the subsidiary or acquiree from accounting point of view? AK. So here in step number 4, we will take the INA of AK Limited at fair value. NCI is not applicable from exam point of view in case of reverse acquisition. Step number 6 is goodwill GBP. You will take the PC in step number 3, less the INA in step number 4. You will get GBP or goodwill. So this was the basic fundamental of reverse acquisition. So do remember, in reverse acquisition, how will you come to know whether it is a reverse acquisition or not? This PC which was given 2 shares for every 1 share, I call it legal PC. So prepare a rough work based on the issue of legal PC. You will easily come to know whether it is a reverse acquisition or not. Okay, chalo, done. Now let's proceed. We have one question to be discussed, that is illustration number 42. Acha, these board notes I will upload on my Telegram channel. You can join it and download the board notes. Okay, don't worry. Chalo, illustration number 42. 42. Here it is. Chalo. Illustration number 42. What does it say? It says that on 31st December, entity A issues 2.5 shares in exchange for each ordinary share of B. So if you see closely, who is the acquirer here? A is the acquirer. Okay. A is the acquirer and B is the acquiree. One second. Sorry, the pencil stopped working. Anyways, in this illustration, A is the acquirer, B is the acquiree. How much shares is A giving? 2.5 shares for each ordinary share of B. So I prepared a rough work for this as well. Okay, if you see closely, here what we are doing is, if I say there are two companies, entity A and B. So if you see the question, A had how many shares outstanding? A had 100 shares outstanding and B had 60 shares outstanding. A is taking over B. How much PC is it giving? 2.5 shares for every one share. So if you say B will get how many shares? 16 to 2.5. B will get 150 shares. That means A has an opening of 100. It is giving in PC 150. So total becomes 250 shares. Now if you see closely, out of 250, 100 is belonging to A and 150 is belonging to B. Okay, so this becomes a case of reverse equation, simple, because B has a stake of 60%. How will I solve this? Identifying the acquirer. Okay, from legal point of view we will write, but main is the accounting point of view. B is the acquirer, A is the acquiree. Solve the whole question assuming B is the acquirer. Date of acquisition is given, deemed PC. Deemed PC means the PC. What if B gave the PC to A? So take the opening shares of B. Opening shares of B were 60. Divide by the stake to be maintained. Minus the opening again. You will get number of shares. Multiply by the share price of company B. So here to confuse you, they have given two share price. The share price of A as well, the share price of B as well. Don't get confused. Okay. They are thinking you are a hoocha, but we're not hoochas. Hoochas means mad people. We are not mad people. We will take the share price of company B, because if B would have issued the PC to A, what would have been the PC? So take the share price of B. You will get the PC of 1600. Okay. Of course, you can give the bifurcation of face value and premium, but in this question, ICI has not considered the bifurcation. Anyways, step number 4 is INA. INA of which company will you take over? You will take over the INA of acquiree. A Limited is the acquiree, I guess, right? So take over the INA of this acquiree. So you will take over the assets at fair value, liabilities at fair value if they are given, you will get net assets. NCI is not applicable in case of reverse equation, you will get goodwill GPP 300. Now, how do I prepare the balance sheet? So before preparing the balance sheet, let's discuss the same in rough. CFS will be prepared from whose point of view? From acquirer's point of view. Who is the accounting acquirer? B. Assume that B is the acquirer and prepare the balance sheet. Okay, how will I prepare? In case of equity capital, remember only in CFS only parent's capital appears. So only B's capital will appear. Plus, don't forget to give the effect of whatever deemed PC was there. Other equity also only B will appear. Liability. B's own liabilities will start carrying amount only. But the liabilities which they are taking over of A, they will take over at fair value. Similarly is the case of assets. Assets, B's own assets will start carrying amount only. But A's assets, they will take over at fair value. Okay. Goodwill, if there is any, don't forget to write it. Step number 6. Okay, this is how we'll prepare the balance sheet. Of course, you need to practice the balance sheet at your home as well. Okay, that's all. So this is how the reverse equation question works. So do the 6 steps. By giving the steps, it becomes very easy. See, why have I given you steps? The main issue, as I discussed in class also, in exam, you read the question, you know it is a similar question, but you don't know from where to start. That issue I have resolved for you. Okay, so always prepare the 6 steps, then try to prepare the balance sheet. Okay, acha. Now there were also 2 theoretical points which you need to remember. Once the whole balance sheet is prepared, do remember this balance sheet. When you write the name of the legal parent will appear. Why? Because this balance sheet we have to submit in ROC and SEBI and everywhere. Okay, legally we have to submit this. So the name will appear of legal only. Do remember the point of view through which we were preparing the balance sheet was assuming B is the parent, but the name of legal parent will appear. Second thing, the number of shares also will appear from legal point of view. Okay. Achha. Extra working note I had discussed also. If we are removing everything from the point of view of deemed PC, do I need the legal PC? Legal PC means the PC which was given legally by legal acquirer to legal acquiree. Do I need that legal PC? The answer is yes. Legal PC is also required. Why? Because how will you come to know that B is the accounting acquirer? How will you come to know whether it is a case of reverse acquisition? That you will come to know when you evaluate through legal PC. That have you given extra legal PC through which the subsidiary has majority stake? That is how you compute the percentage stake of entity B now. So legal PC is also required. Clear guys? Okay. So this was a basic question of reverse acquisition. Now the best question of, I feel, best question of Index 103, considering the fact that it covers 2 concepts. It covers common control also, it covers reverse acquisition also. So let's move on to that question. That is illustration number 38, I guess. Come. Illustration number 38. You can see here. What does it say? So it says AX, BX, we have two companies that amalgamated on 1st January and formed a new company ABX. So AX, BX come together, form a new company ABX. Okay, chalo. So now they have given the balance sheet. Okay. If you see closely, ABX is the acquirer. So ABX will give PC now. So they have given ABX issued requisite number of shares. The issue with this question was PC amount was not given. How much PC is ABX given? That is missing here. So you have to assume some PC. Okay. So PC amount is missing. Anyways, now what they're asking is prepare a note showing purchase consideration and discharge thereof and draft the balance sheet of ABX Limited. There are two cases. First case is assuming that both the entities are under common control. How will you solve this? It is very simple. See, you have to assume PC. So we used to do this in amalgamation in our childhood. Remember amalgamation, CA intermediate? Sir, we forgot everything. So in that, whenever PC was missing, we used to find the PC by net asset method. Asset minus liabilities, right? So we will do asset minus liabilities, but because it is common control, we take over reserves also. So we will deduct reserves also. You will get PC. For AX, you will get 6,000. For BX, you will get 7,000. Now, what is the meaning of discharge? Discharge means how much PC will you give to AX and how much PC will you give to BX. So normally what we will say? We will say give 6,000 PC to AX and give 7,000 PC to BX. But this is not how it has been solved by ICAI. What they did is, they found this PC. They total this up. Total comes to 13,000. Now, they allocated this 13,000 between AX and BX in the ratio of net assets. That means in this ratio. Of course, you can directly give 6 and 7 also, but this is not what ICI is assuming. ICI is taking the total of this and then giving to AX and BX in the ratio of net assets. So this is how we will solve in the class as well. Okay, do remember this. Okay, so this is ICI's assumption. Anyways, let's proceed further. Now, you can also talk about an extra working note here. Okay, why? Because once you give PC, you will have to pass an entry for takeover. ABX is taking over two companies. It is taking over AX, it is taking over BX. Okay. In one company, a debit balance of capital reserve is arising. In one company, a credit balance of capital reserve is arising with the same amount. So it gets netted off. Now, three things were asked. One was the amount of PC, we got the amount of PC. Second was discharge of PC, we bifurcated in the ratio of net assets. Third was the balance sheet. Okay, this is extra, something extra which I am giving, not required also. Third is balance sheet. In common control, how will you prepare the balance sheet? Just total up all the assets and liabilities. Because in common control, you will take over everything at book value. So total up whatever the value is given for assets, for reserves and for liabilities. Just don't take up the equity share capital. Instead of taking up the equity share capital, just write whatever you gave in PC. How much was our PC? Our PC was 13,000 only, by the way. Okay, so here you, instead of taking 6 plus 7, you will just write 13,000 PC. So your balance sheet will tally. So because it is common control, just total of what is given in the question. That's it. Very simple. Now comes the important part of this question, that is part number B. Okay, what is there? It says in part B, now forget part A, okay? When you are solving part B, forget about part A. It says assuming BX is a larger entity and their management will take control over the entity ABX. Now what is the meaning of this? It says assume that BX is a larger entity. That means BX was your acquiree, right? Now if BX is a larger entity and their management will take control over the entity ABX, that means from accounting point of view, it became the parent. So your acquiree is becoming a parent. So it is a case of reverse acquisition. Now how will you solve it? So we will start following the steps. Okay, step number 1, identifying the acquirer. Ideally, you will feel that BX is going to control ABX, but ABX itself is a new company. In the case of reverse acquisition, BX will ultimately control AX. Okay, we discussed this also in class. Okay, so step number 1, identifying the acquirer, legal accounting point of view. Forget the legal point of view, only remember accounting point of view. AX acquiree, BX acquirer, ABX also acquiree, but ABX is the new company. So it is as good as not relevant. Okay. Step number 2, date of acquisition, we already know this. Deemed PC. Now the issue with deemed PC is we don't know the stake to be maintained by BX. Normally we have legal PC now, through which we come to know BX has to maintain this much stake. Okay, here it was given in the question that it is a reverse acquisition. We did not find it on our own whether it was a reverse acquisition or not. It was given in the question. So now in this case, how will you find the deemed PC? Because you don't have how much stake is to be maintained. So for finding deemed PC, first you need legal PC. Okay, legal PC means what if ABX gave the PC to AX and BX? So here there is one information given, that is fair value of business. So if ABX wanted to acquire AX and BX, it could have given the PC of 11 and 14 to AX and BX. Okay, so we find this is the legal PC. So legal PC would have been given by ABX to AX and BX. Okay, PC has been considered based on the fair value of business. To AX they will give 11,000, to BX they will give 14,000. Total comes to 25,000. Okay, so out of this, how much percentage stake does AX have? 44%. And how much percentage stake does BX have? 56%. This also goes to prove that BX is having the control. Okay, now you can find the deemed PC. Take the opening shares of BX, divide by the stake to be maintained, 56%, minus the opening again. You will get the number of shares. Then one more important thing, we will multiply by the market price of BX, because deemed PC is being given by BX. Multiply by the market price of BX, which is not given here. So you will normally say, sir, take face value only. Face value, market price same. No, you can find the market price. How come? If you have the fair value of business, divide it by the number of shares, you will get the market price of the share. You will get the market price of each share. This you do in AFM also, but I'm assuming you don't know AFM anyways. So fair value of business divided by the number of shares, you can also get the market price of BX Limited share. So 550 shares multiplied by rupees 20, you will get the PC. You can do the bifurcation of face value and premium. Here ICAI has done the bifurcation. Okay, chalo. Anyways, so in some cases ICAI did the bifurcation, in some cases ICAI did not do the bifurcation. I feel in exam you should always give the bifurcation of face value and premium. Okay, chalo. Step number 4 is acquiry. Do remember who is the acquiry. There are two acquiries, AX and ABX. As I said, ABX is a blank company. It is as good as not existing. Just remember AX. AX says IND will take over at fair value. So assets of AX at fair value, liabilities of AX at fair value. To confuse you, they have given the fair value of BX also. Fair value of asset of BX also. BX is the acquirer. Acquirer's own asset liability will stay at carrying amount only. It will not be recorded at fair value. Do remember that. Okay. So assets and liabilities will come at fair value of acquiry. Step 5, NCI not applicable. Step 6, goodwill GBP, you will get it. Okay, then you have to prepare the balance sheet. How will you prepare the balance sheet? This rough work is the best way to understand the balance sheet. First, from whose point of view I am going to prepare the balance sheet? From BX's point of view. So equity, capital and other equity, only of BX will come. Of course, the PC of deemed impact will come. Okay, so face value and premium impact will come. Then liabilities. AX being the acquiry, we will take at fair value. ABX being the acquiry, we will take at fair value, but ABX is a blank company, nothing will come. And BX's own liability stays at carrying amount only. Same is the case with assets. And finally, don't forget to record the goodwill in your balance sheet. This is something which you will surely forget. Okay, so do remember, don't forget it. Okay, chalo. So this is how you can do it. So also I have given the key points of this question. In this question, only 3 points were important. In part A, PC was missing. So how did we find the PC and how did we discharge the PC? That was important. In part B, 2 points were important. First, legal PC was not given. We assume the legal PC to be fair value of business. We need this so that we can come to the percentage stake. Okay. Then under deemed PC, we don't have the market price of BX's share. So we assume it to be fair value of business of BX divided by number of shares. That is how we do it. This was illustration number 38. Okay. On reverse acquisition, we have one more question, that is solved example number 1 of my question bank, if you can see. Okay. If you are able to solve these questions which are discussed, okay, the solved example you can just practice in homework. It is solved example number 1 of my question bank. Okay, just revise it. We did this in class also. Okay, chalo. So this is something what we did. So this ideally, then we did some questions also. See, in this part, I am only focusing on revising the important LDR questions. But of course, you can also refer illustration number 1 of my notebook, question number 2 of my classwork book. Okay, this also you can refer. Then after doing this discussion, so if I want to show you the chart, now see, I'll show you one chart. Okay. If you see here, what all things are done. Definition of business done. Control detailed discussion comes in 110. Business elements of business. Remember, input, process, output, it was done. This test is pending to be revised. I will revise it. Asset acquisition we discussed. 6 type of business combination is done. Common control transaction is done. Demerger is done. Reverse acquisition is done. Other important points, measurement period is done. So only this point again is pending, determining what is part of business combination. So this concentration test, this point, and one point was there in PC also, that is non-replacement award. That is also pending to be revised. These 3 points I will revise, and there are some questions to be revised, and then this revision video will be over. See, by preparing this chart is not useful when you study for the first time. This chart is useful when you revise it multiple times. So you come to know what is there in this chapter. Okay, Chalo. Now let's continue with the revision from concentration test, I guess, right? Chalo, come here. So what is the meaning of concentration test? So this is first of all, this is an optional test. What do we check here? You have to check whether whatever PC you have paid, whether you have paid the PC for whole business or you have substantially paid the PC for one asset. Okay, so we say if you have paid at least 90% of the PC for one asset, that means your whole PC is concentrated into one asset. In that case, this test is met, and if the test is met, it is an asset acquisition. Why? Because if this test is met, it goes to prove that your 90% PC is concentrated into one asset. So it is an asset acquisition. Okay, it is not a business. But if this test is not met means that means you have not paid PC only for one asset, you have paid PC for multiple things. So then the test is not met, then it may be a business. Of course, this test does not give conclusive answer, that is why it is an optional test. Now how do I solve it? You need to find three amounts in this. First is fair value of gross asset acquired, which I call adjusted PC also. How will you find this? You need to remember this. Remember we discussed also total PC plus NCI plus previously held investment less cash and DTA, and add back all the liabilities excluding DTL. How do I remember this? It is so difficult. To remember this, one hint I had given. Do you remember the step 6 of business combination? Goodwill, PC plus NCI plus previously held investment, we do minus INA. What is the meaning of minus INA? Minus INA means you are deducting the assets but adding back the liabilities. Okay, this is the interpretation of minus INA. This is exactly what we are doing in this step. The only difference is we are not deducting all the assets. We are only deducting cash and DTA. We are not adding back all the liabilities. We are adding back all excluding DTL. Simple. Okay, this is how we find adjusted PC, or in ICI language we call it fair value of gross assets acquired. Then step 2 is single major class of asset. So in question you will find which is the highest value of asset you are acquiring. Step 3, conduct the test. Amount in step 2 divided by the amount in step 1 into 100. If this percentage comes more than 90 or above 90, then this test is met. It is an asset acquisition. So to conclude this, we have one example also. Let me see that example for you. Okay. Acha, if anyone wants to buy these notes are available on makemydelivery.com. So you can go and purchase it. Okay. In case if you need the notes, if you have it, well and good. Chalo. Okay. So concentration test. Okay. So here if you see, we have 20% investment before, then we acquire a further 50%. So that means NCI becomes 20 plus 50, 70 belongs to us, so NCI is 30%. And this 20% is previously held investment. For 50% which you acquired in the latest, you are paying a PC of 300. Fair value of asset is given, building 1000 and cash 200. Liabilities is 800, DTL is 150, DTL as it is we ignore. Okay. Then fair value of NCI is 120, fair value of previous investment is 80. How do I solve this? First part is finding the adjusted PC. What will you do? PC plus NCI plus previous investment less in assets. Don't less all the assets, less only cash and DTA. DTA was not there, less cash. Add all the liabilities but excluding DTL. So we do it. We get answer of 1100. Then single major class of asset. There are only two assets given. The highest value is building 1000. Take that value 1000. Okay. Then step number 3, take the lower amount divided by the higher amount. Simple. So step 2 divided by step 1 into 100, you get an answer of 90.91%. That means 90.91% PC is paid for only one asset. So it is an asset acquisition, test is met. Simple. Guys, are you getting this point? Okay, sir. Got it. So this was your concentration test. Okay. Then under business combination in step number 3 PC, there was one point which talked about non-replacement award. Do you remember this? Okay, what is the meaning of non-replacement award? See, remember in replacement award, what was happening? Acquiree had a SBB plan. So when I was acquiring a subsidiary, I took over the plan of that subsidiary also. I took over the share-based payment plan of that subsidiary also. In non-replacement award, you are not going to take over the plan. Okay, the plan was announced by subsidiary. Subsidiary has the responsibility to issue the shares to the employees. Parent won't do anything. So here, nothing will form part of PC. First thing. Second, non-replacement award can be of two types. See, I have done the conceptual discussion in the notebook. If you want, you can refer it. But just remember, from summary point of view, non-replacement award can be in the two categories. One is vested. Vested means, let's say the plan was announced by acquiree for 5 years. On date of acquisition, 5 years are over. The vesting period is over. Only the issue of shares is pending. So what will be the impact on your CFS? in CFS, these SBP reserve of subsidiary will form part of NCI. Why? Because when subsidiary issues the shares to employee, the stake of other holders will increase. Parents' number of share will remain the same, but because the subsidiary is giving its shares to employees, the other holders, that is the NCI, will increase. So that is why if there are any vested options, vested means subsidiary announce the plan till date of acquisition. That means the date when parent acquires subsidiary, till that date the plan duration is over. Only issue of share is pending. So till the shares are issued, it will form part of NCI from the point of view of CFS. First case. Second case, non-vested. What is the meaning of non-vested? Let's say the plan was of 5 years, but till date of acquisition, only 3 years have lapsed. Okay. So here again, you will bifurcate into pre and post. Okay. Again, I'll repeat. Just because you're bifurcating between pre and post does not mean it will form part of PC. No, it won't come in PC. The amount which is coming in pre, it will immediately form part of NCI. And the amount that is coming in post, it will become part of NCI over the period. The calculation of pre and post is same as replacement award. For this, we had also done illustration number 28. So you can also refer illustration number 28. That is a good question where you will understand the calculation. It is very simple. Okay, chalo. Then, so now this is done also. Now the last part is there, which was I get point number 9. Okay, in other important points, measurement period, I guess we already discussed. The last point was here, determining what is part of business combination transaction. Okay, what is part of business combination transaction? Now what do we check here? So basically you have to check, in class also I revised this for you, whether whatever PC you are paying in 103, whether you have paid whole PC for acquisition only, or whether in this PC you have settled some old transaction. So sometime what might happen is one case. Let's say a company had filed a case on me. Afterwards, I acquired that company. I acquired this Mru Limited. Mru Limited filed a case on me. Now I acquire Mru Limited. Okay. So of course, Mru will revoke the case now. So it is assumed that whatever PC you are paying in business combination, you will also pay some consideration for the ongoing case, because Mru will revoke the case. But if she wouldn't have revoked it, I would have lost the case and I would have to pay 10 lakh rupees. So I will assume that out of 100 lakhs PC, 10 lakhs was paid to settle this old transaction of case which was ongoing. Okay, so PC for 103 will only be considered to be 90 lakhs. So here in this point, the standard tells us to check whether the PC you have paid, whether you have settled any old transaction or not. If you have settled any old transaction, remove that amount from PC and the balancing figure will be the PC as per Ind AS 103. So there can be two types of cases. One is a non-contractual relationship or non-contractual transaction, which I discussed. Case. A company filed a case on me. I acquired that company. So I will assume that whatever PC I am paying, I also paid for the past case. And one can be a case of contractual relationship. It was linked to reacquired rights. Remember, I sold my franchise to a company. Then I acquired this company. So my own franchise came back to me. So I will record my own franchise at fair value. That was known as reacquired rights. So here what is done is, your own franchise has a carrying amount of 9, but you are acquiring it at a fair value of 16. How much excess you are paying for your own franchise? So it will be fair value minus carrying amount, that is 7 CR. Okay, so that means for your own franchise which you had sold, that franchise is coming back to you and coming back to you at a higher value. So whatever is the excess value, we will assume that this is a settlement of old transaction. Okay, so either the difference, either the excess amount, that is carrying amount, fair value minus carrying amount, or there is also one option that instead of reacquiring it, you can pay a penalty and cancel off the franchise agreement. So if the penalty is lower, you will feel like cancelling it, but if the excess amount is lower, you will pay the excess amount. So that is why we take, in a case of contractual relationship like reacquired rights, we will take lower of fair value minus carrying amount or settlement value, whichever is lower. So let's say the lower amount comes to 7 CR. So let's say I paid a PC of 100. So I will assume that out of 100, 7 CR I have paid to settle this old reacquired rights. Okay, balancing figure will form part of PC. Do remember, here I'm just focusing on revision. Detailed discussion we have done in the class itself. Okay, on this there was a question also of illustration number 20. Do revise it. It is a good question. Okay, now so conceptually we are done. Now 2-3 questions are pending. Just have a look here. One was illustration number 34. Okay, it was a theory question. What does it talk about? It simply says one thing. Whenever you apply common control, don't apply from current period. Apply the common control to comparatives also. That is, apply from the first day of the year. Okay, first day of previous year. So let's say you apply common control from you took over on, let's say, 1st September 17. So don't apply common control from 1st September 17. Apply from the day 1 of previous year. My previous year will be 16-17. So day 1 will be 1st April 16. Apply from that date. Okay. But this you will do provided the main parent, the ultimate parent, had acquired all the subsidiaries before that only. Okay. So there is a case B also, where the ultimate parent acquired subsidiaries maybe on 1st August 16. So the earliest date cannot be 1st April 16. It can only be 1st August 16. Okay. So for detailed understanding, just refer this illustration once. Just revise it once. It can land up in a MCQ. Okay. Then, okay. So there were two more questions here. LDR question, which I feel I should revise this with you. Okay. One was question number 1 of MTP RTP past exam. Okay. So basically, this was question number 1, where we are acquiring a company. Okay, so assets, liabilities are given. Now normally what we do, we take the, for deferred tax impact, we take the fair value as carrying amount, and we take the old carrying amount as tax base. But here specifically the tax base was given. So if specific tax base is given, don't consider this old carrying amount as tax base, consider the specific tax base which was given. Okay, first thing. Second thing, in this question, one adjustment was there relating to brand. Okay, there is a brand which is not appearing here. So brand, if we are taking over, if it is self-generated, we will not record it. If you are purchasing in a business combination, you can record it. So brand, I will record it. But one line was written that brand does not have any cost for tax purpose and no tax deductions are available for the same. So normally this line has an interpretation that the difference on brand is other than temporary. But there can be a second interpretation of this as well, that this goes to say that the tax base of brand is nil. Okay, so either you can interpret that the brand difference is other than temporary. In that case, no deferred tax will come on brand. Okay, or second interpretation can be the tax base of brand is nil. This goes to say that brand does not have any cost or any deduction. That means the tax base is nil. So deferred tax will come. Normally, I feel when this line was written, in case of Ind AS 12, they had assumed the first part when they were doing Ind AS 12. But here they have taken the second part as the assumption. That means they have assumed that this is to be interpreted as the tax base is nil and you will have to create a deferred tax on brand as well. ICAI assumes this. I am revising this question only for this line. Okay, so how do I solve this? In this question, there were two things which were asked. First was the amount of deferred tax. How will you find it? So follow the steps. Acquirer, date of acquisition, PC, it is given. INA, take over at fair value. Don't forget to take the brand. Okay, then deferred tax will arise. On plant, some liabilities are there and brand was there. On brand, do remember there is no other than temporary difference. You have to create the deferred tax liability. Okay, ideally you net off the deferred tax asset liability. In question, it was said that do not net it off. Show it separately. So I am showing it separately. So we will take this over separately. Do remember this part. Okay. Okay, sir. Acha, one more thing. Some deferred tax were already existing also. DTA was there in the old company. DTL was there in the old company. So because you are finding the DTA DTL separately again, do not again take over the old DTA DTL. Just take over the new DTA DTL which is arising. Okay. Reason I have given below as well. Reason I have given here. Okay. Chalo. Then you will get the NCI. It was nil because we are taking over 100%. Goodwill you will get PC plus NCI minus INA, will get the goodwill. Simple. Okay, for brand also, again I have given this note. So just practice this question. Only this is the adjustment where you will get stuck. Other everything is same. Okay. Then the last point of this chapter was which was illustration number 51 and question number 6. Okay, so these two questions had a contradiction. What was the contradiction? Just listen to me. So one company is acquiring over another company 100%. PC paid was 38 CR. Against that, we are acquiring assets of 68, liabilities of 50. So net assets were 18. Apart from these net assets, the following, so it is said assets and liabilities were this much, but does not include the following. These three are not included in your INA. So if it is required, we will have to include it. So first a patent was given worth 8 CR. So we will add 8 CR. Then second part. Again, we are acquiring a drug, patented drug. The cost was 13, market value was 19. Normally what we do? Normally in case of business combination, we take over at fair value. But if you go to read Ind AS 38, in Ind AS 38 it is said that you will take fair value only when it belongs to active market. If you feel active market fair value is not available, you will not take over at fair value. You will have to consider at cost only. Okay. So here they have inherently assumed that the fair value given is not belonging to active market. So here we will take over at cost only. This is the assumption. No hint given, but they have assumed this. Okay. Then there was a asset which we received in grant. So when we receive any asset for free in grant, you record the asset and grant both either at fair value or at nominal value. So if you recorded fair value, it was worth 7 CR. So license and DGG both will appear at 7 CR. Okay, so both I have recorded, license and DGG is a liability, so negative. So in this question, one part was important, that for a drug, cost and fair value both were given. They have assumed that the fair value is not of active market, so they have taken the cost. Okay, but there is a contradiction in illustration number 51. Same illustration, exactly everything same. Here also they have given cost and fair value, but here they have considered for the drug as fair value. They have taken the fair value. They have assumed, they have not done any discussion of active market here. So sir, what do I follow in exams now? In exam, whatever you follow, you can either follow this or follow this. Give a note for it. Also, I told you, in exam, I feel more clarity will be available in the question. Okay. Acha, one more part, there is contradiction. See, in the question number 6, we are taking license and DGG both at 7 and 7. Here they are taking the license, but DGG they are not taking over. They are taking nil. Why? Because they are assuming that the grant is unconditional. Okay. So whatever grant you got, you will transfer to P&L on day 1. So DGG balance is left as nil. So only license will appear. So this same thing they did not assume in question number 6. Okay. So in question number 6, they are taking license and DGG both. In illustration 51, they are only taking one license. DGG they are assuming it is a unconditional grant, so no DGG will be there. So what would an exam? Again, give a note and accordingly you can assume things. Okay, chalo. So finally, this was the revision of IND AS 103. I have tried to revise complete IND AS 103 along with questions. Of course, the best way of utilizing the revision video is the concepts which you are able to recall, very good. But there will be few concepts which you did not recall. Just mark it, and after the revision video ends, only revise those concepts. Secondly, the question which I revised with you, solve and practice those questions. There is no alternative to write and practice. I only try to revise the question so that you get comfort zone. That, ha sir, we knew something is like this and we can do it. Okay, so just revise the concepts which you're not able to recall and revise those illustrations. Okay, on that note, we will wrap up this session. I hope you liked it. In case you liked it, if you watched till here, don't forget to leave a comment in our YouTube section so that I can come to know whether you are understanding or whether this is helpful for you or not. Okay, and if you wish to recommend my lectures to your friends, it is available on bbvirtuals.com. At last, one small promotion that I can do now. Okay, so thank you so much. I will wrap up this session. Thank you so much. Bye bye everyone. Take care. See you all.